Cost of goods sold. In the last video, we covered revenue, and this video will be our introduction into expenses. The simplest definition is money entering the business is called revenue, whereas money leaving the business are called expenditures. Expenditures come in various different forms. However, I'm trying to keep this series as close to real life investing as possible. And there's a high probability that the first financial statement that you will look at is the income statement. And as we learned in the last video, the first line item you will see under the income statement is revenue. And the second one you will see is something called cost of goods sold, or cost of something. More on how you may see it called something other than cost of goods sold later. Okay, let's talk about the definition of cost of goods sold. Cost of goods sold, or COGS, refers to the direct cost of producing the good sold by a company. It includes the cost of materials and labor directly used to create the good. Here's where it gets tricky. Generally accepted accounting principles, or GAAP, are the standards that encompass the details, complexities, and legalities of business and corporate accounting. GAAP has a pretty loose definition on what can and cannot be included in your cost of goods sold. The only way to fully combat this is to actually read the company's annual reports and quarterly reports and see what they are including inside of their cost of goods sold. To highlight how to find their cost of line item, let's use a real example. Let's look at Apple's income statement from 2022. So here you can see that they are using the term net sales in lieu of revenue, and they break that into two major categories, products and services. They report cost of sales because there are two major cost centers, both in their products and their services. The accompanying paragraphs describing their costs do not provide any further detail, but you can make assumptions based on what their cost of sales would be. For instance, paying Foxconn to produce their iPhones would be a direct cost of producing goods sold by a company. And that's really it. Cost of goods sold as a lone number does not provide a lot of insight into the long-term competitive advantage of a company. However, it is the second figure we need in calculating gross profit. And gross margin is one of the most important indicators of a company's long-term business success. If you found this video helpful, please like and subscribe, and I'll see you on next week's episode. Thanks for watching.